समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉप अप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Hello and welcome to The Print. This is Bidisha and you're watching Economics. Let me begin with something that doesn't quite add up. We are living through a world of conflict, uncertainty, and rising geopolitical tension. In moments like this, markets usually behave in very predictable ways. Investors look for safety, they move away from risk, and they turn to assets that are expected to hold value in turbulent times. And historically, nothing represents that instinct better than gold. So gold should be rising, but it isn't. It's falling. Now, at the first glance, this seems like a contradiction, but it really isn't. In fact, it's a clue, a signal. Before we go further, let's address the obvious explanation. Many analysts around you will tell you that there's nothing unusual happening here. When interest rates are high, gold tends to fall because gold doesn't pay interest. So when safe assets like government bonds begin offering attractive returns, investors shift away from gold into those income generating assets. That relationship is real. It is well understood, but it is also a little incomplete because it assumes that what we are seeing is a normal adjustment. And this is exactly where the story becomes more interesting. In a typical high rate environment, gold may not surge, but it doesn't usually fall despite rising geopolitical risk. That combination is unusual. So the real question is not why isn't gold going up? The real question is why is gold being sold when fear itself is rising? And the answer to this is liquidity. Liquidity simply means access to cash. When liquidity is abundant, investors are comfortable. They hold assets, they take risks, they don't feel the need to sell. But when liquidity tightens, behavior changes. Investors don't ask what they want to sell. They instead ask what they can sell quickly. And gold, being highly liquid, often becomes one of those assets. So gold falling today is not just about interest rates. It is about a system that is beginning to need cash. To understand why, we need to step back. For the past 2 years, the global economic conversation has focused on inflation and interest rates. Central banks raised rates sharply, growth slowed but did not collapse, and markets concluded that the system had absorbed the shock. But the conclusion is premature. Because the impact of high interest rates does not happen all at once. It happens with a delay. And this is exactly where the first chart becomes crucial. What this chart on your screen is showing is not just debt, it is timing. So the first question to ask is, when does global corporate debt actually come due? Look at the chart carefully. In 2024, the pressure is still relatively low. Most companies are still servicing old loans taken when interest rates were very cheap. So even though rates have gone up, their actual interest payments haven't fully adjusted yet. Now move to 2025. You begin to see the shift. Debt starts maturing, companies have to refinance, and for the first time, they start replacing cheap debt with expensive debt. But the real turning point is 2026. This is exactly where the bar peaks. That is where the largest volume of global corporate debt resets into a high interest rate environment. And this is the key insight. The biggest impact of higher interest rates is not behind us. it is ahead of us. Even in 2027 and 2028, the pressure does not disappear. It remains elevated, which means that this is not a one-year problem. It's a multi-year adjustment. So what this chart tells you is something very important. The world has not yet felt the full effect of higher interest rates, because much of the debt has not yet been refinanced. This delay is what in economics we would call the refinancing lag. Rates rise first, pain comes later. Now, just as this refinancing wave is approaching, we need to ask, are companies in a strong position to handle it? And this is exactly where the second chart becomes important. This chart looks at something called the interest coverage ratio. Now, that may sound technical, but the idea is very simple. Interest coverage ratio basically measures how easily a company can pay its interest. Think of it like your own finances. If your income is 3 times your interest payments, you are comfortable. If it falls closer to 2, you are still okay. But if it keeps falling, you start to feel the pressure. Now look at the trend. In 2021, companies were in a strong position. Their income comfortably covered their interest payments. Debt was manageable. However, after that, interest rates began to rise. But initially, their impact was muted because companies were still paying low rates on old debt. But by 2023, the picture begins to change. The ratio starts falling. Companies are earning less relative to what they owe, their financial cushion is shrinking, and by 2024, we reach the weakest point. This is the moment when companies are most vulnerable. Their ability to service debt is at its lowest. And now, notice something critical. This weakness is happening before the peak refinancing pressure we saw in the first chart. So now bring the charts together. The first chart tells you the biggest reset of debt into high interest rates is still ahead. And the second chart tells you companies are already getting weaker. And that combination is what makes this cycle dangerous. Because it means the system will face its biggest increase in borrowing costs at exactly the moment when it is least able to absorb it. This is the refinancing lag in action. And this is what markets are beginning to sense. This is exactly why gold is falling, because markets are not just reacting to today's conditions. They are reacting to what is coming, to tightening liquidity, to rising financial stress, and in that environment, cash becomes more important than safety. Liquidity becomes more important than hedging. Even gold gets sold. This also explains why markets still appear relatively calm, because we are in the gap between cause and effect. Rates have already risen, but the full consequences are still unfolding. India, of course, enters this phase from a position of relative strength. Corporate balance sheets are healthier, banks are better capitalized, growth remains robust, but the refinancing dynamic does not disappear. It arrives with a lag. External borrowing will become more expensive, domestic savings are being absorbed by government borrowing, so India is not insulated. It is simply on a slightly different timeline. And this brings us to the real issue. The policy debate is still focused on interest rates, where they should go next. But the more important question is not about the level of rates, it is about timing. The question is, when will their full impact be felt? Because the largest adjustment is still ahead. Gold falling in a world at war is not just a market anomaly. It is a signal that something deeper is shifting beneath the surface. Not a crisis yet, but a build-up. Not a collapse, but a delayed adjustment. And that is exactly why the real economic shock is still ahead. Thank you for watching.